Federal Reserve may very soon lose control of interest rates. This is due to the fact that the United States government is set to go on a massive borrowing binge to the tune of $1 trillion. This could end up sucking so much liquidity out of the banking system that it pushes rates high enough that the federal government can no longer afford the interest payments on its debt. And if that happens, then the Federal Reserve would very likely need to respond with something they've never done before: outright yield curve control. So what in the world could happen that could cause it to play out this way? Well, we all know that the Federal Reserve has been fighting inflation by raising interest rates. This is just one of the tools the Federal Reserve uses for monetary policy. This is a sledgehammer approach. It is painting with a broad brush stroke. What they hope is that it makes debt difficult to afford, and so people will pay off debt instead of getting new debt. One of the results will be a declining money supply like we've seen over the past year. But even saying that the Federal Reserve is raising interest rates is somewhat of a misconception, because they're only raising one very specific interest rate, and that is the federal funds rate. This is the rate at which depository institutions trade federal funds with each other overnight. The Federal Reserve hopes that by raising the Fed funds rate, it will influence the rest of interest rates in the system. But raising interest rates is not the only thing the Federal Reserve does. They also do quantitative easing or quantitative tightening. And this is where their balance sheet either increases or decreases depending on what goal they want to accomplish. Since the Federal Reserve creates new dollars in order to buy things that adds to its balance sheet, that also means that when things leave its balance sheet, they're exchanged for dollars, and those dollars cease to be in circulation. So both interest rates and their balance sheet are the two tools the Federal Reserve uses in order to try and drive prices either up or down. But both of these, like I mentioned, are very broad brushstrokes. These are sledgehammer approaches. They have far-reaching consequences across the entire economy, and they are not fine-tuned approaches to try and dial into one specific area of the economy. These are simply tools to make debt either very expensive or very cheap for everybody, or to make money more abundant or less abundant for everybody. And over the past year or 2 years, they've been somewhat successful at making money harder to get as interest rates have gone up, and they are much higher than they've been in a very long time. This also means that it is more expensive for the United States government to borrow what it needs for its expenses. Now, there's no shortage of news right now about the debt ceiling, with both sides of the aisle in Washington going back and forth, not wanting to be the one to give in, even though at the end of the day, we all pretty much know they're going to come to some sort of agreement to allow the government to maintain its power, maintain its spending power, and ultimately borrow and spend even more. But they're not able to borrow more money right now to fund their current expenses. So how are they paying for all of their expenses? Well, very simply, they're paying for their expenses from past borrowing. If you take out a loan and you deposit the cash from that in your checking account, and then you spend that money down from your checking account, you're not borrowing new money when you're spending that. You've already borrowed that. But if you get down to $10, $5, and you have some expenses coming up, then you may need to borrow again to refill that checking account. Assuming, of course, you're a degenerate borrower and you've never produced a single cent of income in your life. You've only taken or borrowed from other people like the United States government. And this is exactly the position that they are in right now. This is their Treasury General account. It is their checking account. You can see when COVID started, this big spike in their checking account when they did a lot of borrowing, and then the subsequent drop in their checking account as the bills passed and they were able to spend a lot of that money down. But this checking account is getting dangerously close to running out of money. And estimates like from Janet Yellen say that they have until probably about June 1st before they start defaulting. But like we already covered, they'll probably resolve the issue just the night before and come up with a new plan on being able to spend and borrow more. But this comes with its own set of very big problems. The US government is going to have to refill that checking account, and they may have to borrow up to $1 trillion. Now, in normal circumstances over the past, let's say 2 decades, that might not be an issue, but it's an issue today because the national debt is already above 31 trillion. So it is way higher than it has ever been in our history. But most of that debt was borrowed at rock bottom interest rates. rates. It was borrowed during 2014 and 2015 and 2016 and in 2020 when interest rates were down under 2.5%, even under 1%. Now, we know they're not paying off that debt in the sense that they are going to reduce the total amount of debt they have, but they do have to pay back that debt when it comes due, and they do that by borrowing new debt. Now, tell me what happens when you have debt with a 1% interest rate and you have to pay that off by borrowing new debt at a 3% interest rate. Do your costs go up by 2%? No, your cost triples, because if the interest portion you owed on your debt before was $100 per year at 1%, and now your debt is at 3%, that means your interest portion on your debt goes up to $300 per year. And this is exactly what is happening to the interest payments for the United States government. They are absolutely skyrocketing. Within the next few months, interest expenses are set to overtake the amount the federal government spends on national defense. And the increased borrowing of up to $1 trillion that the United States government is set to do once the debt ceiling issue is fixed will only make the problem worse, because they're borrowing at current interest rates, which are higher than they've been in a very long time. If we take a look at a recent daily treasury statement, which includes information about where the government is spending money, we can see that in one day, the net change in the operating cash balance was that it dropped by $52 billion, but almost 51 billion of that was just from interest on treasury securities. So when the amount of money in the federal government's treasury checking account drops drastically, a lot of that is simply the treasury paying interest expenses, interest on its debt. And with the government set to borrow up to $1 trillion more to refill its coffers, it's doing that at these sky-high interest rates, which is only going to make this problem worse. The reality is, at the current pace, with the Federal Reserve doing quantitative tightening, which means shrinking its balance sheet, and the Federal Reserve raising interest rates, while the federal government has to borrow more and more. It is a question of when, not if, the government can no longer afford to pay its interest on its debt. At some point soon here, potentially even before the next couple of years are done, the interest expenses on the federal government's debt may be the largest line item on its entire budget. When the market starts to question whether or not the federal government has the ability to pay back its debt simply because interest rates on its debt are too high, interest rates will go up even more. Because let's say you have a credit card at 5% and you're maxed out and you're calling the credit card company saying, I don't know if I'm gonna be able to pay, but can I get a new credit card as well? The only circumstance in which they will give you that additional credit line is if they're gonna charge you a much higher interest rate so that they can be compensated for the risk. And the exact same thing would happen with the federal government. The more and more they have to borrow, despite how expensive it is for them, the more and more the market is going to charge them in interest. On top of this, government increasing its borrowing sucks money out of the system, because when you can purchase a debt instrument from the federal government and get paid 5, 6, 7% on it, you are likely not going to risk investing in something that might give you a 4 or a 5% return in equity if it has the chance to fall. And so high interest rates on government debt suck money away from the productive private sector. And the more money it sucks away from the productive private sector, the less money there is to go around. And the less money there is to go around, the harder it is for the federal government to tax what it needs, which means it's going to end up needing to borrow more. A self-reinforcing cycle that pushes its interest expenses much higher very quickly. Obviously, this is a cycle that cannot continue forever, and the obvious solution is that the Federal Reserve comes in and saves the day again. But then what happens to their quantitative tightening to fight inflation? And they're raising interest rates to fight inflation. Well, it's very possible they continue to allow things to get tighter for the rest of us while they come in and try and save the federal government with yield curve control. Like I mentioned in the beginning of the video, the two tools they use today, quantitative easing and tightening, and interest rates lowering and hiking, those are broad brushstrokes. Those are sledgehammer approaches. They influence the entire economy. They're not targeted. They're not laser focused. But the Fed has switched tactics lately to a more laser-like approach. They've recently orchestrated and helped the bailout of just depositors at banks while letting the banks fail, the shareholders lose their money, and not making any explicit guarantee for any of the other banks in the system, especially not the ones that are not deemed systemically important. This is because the Federal Reserve does not want to add any undue stimulus to the economy, which could reignite inflation. But this means that the Federal Reserve may very easily lose control of interest rates. Right now, the yield curve looks like this, with the shortest debt yielding the highest interest rate and the longest term debt having the lowest interest rate. As this death spiral continues, rates shoot up, and the Federal Reserve might very well see that interest rates, especially for the government, are much higher than they want them to be. At this point, the Federal Reserve, in my opinion, is likely to engage for the first time in yield curve control. Yield curve control is fundamentally different than quantitative easing. This is the Federal Reserve's balance sheet, and you see when the balance sheet is increasing, moving sideways, or decreasing, it does so at a fairly consistent pace. This is because the Federal Reserve targets a specific number of assets to buy or sell. That then influences the pricing of those assets on the market, though it does not completely control the prices of those assets. Imagine if Apple were to go on eBay and they said, we are going to buy 1,000 used iPhones every single day. Certainly, the price of used iPhones would go up. And so Apple would be able to engage in that behavior to drive up the price of used iPhones, but they wouldn't be able to completely control it. For instance, if there is a big hoard of used iPhones on people's shelves at home and they're worth $500, now they know there's a new buyer that has committed to buying 1,000 used iPhones every day. Now everybody can go sell those and not worry about pushing the price down. But if too many people come out and sell them, they may soak up all that extra buying pressure from Apple and still have a downward pressure on the prices of used iPhones. So that's an example of quantitative easing. It's targeting a specific number of purchases that has an influence on pricing, though it does not directly control it. Other option, which the Federal Reserve will engage in the future, in my opinion, is yield curve control. This is like if Apple went on eBay and said, we are going to buy up every used iPhone for a minimum of $1,000. And we will allow the prices of used iPhones to go above that, but we will set a floor. And no matter how many iPhones are sold, we will make sure that there is a buyer, us or somebody else, at $1,000 per used iPhone. This does directly control the price of those used iPhones and says that no matter how many we need to buy, we will buy as many as possible to achieve that specific price. So right now, the yield curve looks like this, with the shortest term debt being the most expensive and the longer term debt being the cheapest. As the federal government needs to borrow more and has higher and higher interest rate expenses on its debt, the Federal Reserve could come in and say, all right, federal government, as long as it's, let's say, the 10-year, we will make sure that you have cheap borrowing costs. And no matter how much debt you need to issue, we will be the ones that lend that money to you at the low cost. This would target interest rates and make sure that interest rates don't change. It would also create an incentive to anybody who holds US debt to sell it, because they know no matter how much of it they sell, they could never push the price of it down. There is a buyer with unlimited buying power, because it's the Fed and they print money, willing to buy any and all necessary to keep the price exactly the same. Now, this isn't full-blown MMT printing money to finance all government expenses, but it's the next step. It's one step closer. Quantitative easing was the first step. The next step beyond that is yield curve control. And then the final step is just going full-blown money printer for all expenses. But we're not quite there yet. We will most likely get yield curve control first. So due to the rising interest costs for the federal government and the massive demand the federal government has to borrow more and more for ever increasing spending, it's very likely the Fed will have to step in and directly control interest rates so the federal government can continue to borrow without defaulting. And no, that does not mean that the stimulus will make its way through to you and I. They will likely keep on ratcheting up the pain for households and the private economy, at least until they have inflation beat. And yes, financing government spending to be able to spend more and more will absolutely make it harder and harder for them to beat inflation. If you'd like to learn all the methods and strategies that I use in order to grow and protect my wealth during crazy times like this, join Heresy Financial University, linked in the description below. As always, thanks for watching. Have a great day.